The government just quietly handed seniors one of the biggest tax breaks in years, and almost nobody is talking about it. If you are 65 or older, you may now be eligible for a brand new tax deduction worth up to $6,000 per person, or $12,000 if you're a married couple filing jointly. That is real money off your tax bill, not a credit you have to apply for, not a rebate you have to wait 6 months to receive. A straightforward deduction that reduces the income you owe taxes on starting right now. But here's the catch. This deduction is temporary. It's only available for tax years 2025 through 2028. And after that, unless Congress extends it, it disappears completely. That means you have a 4-year window to take advantage of this, and if you miss it because nobody told you about it, that money is gone forever. And that's exactly why I'm making this video today, because millions of seniors are eligible for this deduction right now and have absolutely no idea it exists. So today I'm going to explain exactly what this new deduction is, where it came from, who qualifies, how much you can save, what the income limits are, and how to make sure you actually claim it on your tax return. By the end of this video, you will know more about this deduction than 90% of the people out there, including a lot of tax preparers who haven't caught up to the new law yet. Let's start from the beginning. Where did this deduction come from? On July 4th, 2025, a new law was signed called the One Big Beautiful Bill Act. And buried inside this massive piece of legislation was a provision specifically designed to give tax relief to seniors. It didn't get a fancy name, it didn't get a press conference, it didn't get its own website. It was just quietly tucked into the bill alongside hundreds of other provisions. And that's exactly why so few people know about it. The media covered the bigger headlines in the bill and skipped right over this part. But for anyone 65 or older with a moderate income, this could be one of the most valuable tax breaks you've seen in a very long time. So let's break down exactly how it works. The new law creates an additional tax deduction of up to $6,000 for individual taxpayers who are age 65 or older. If you are married filing jointly and both you and your spouse are 65 or older, you each get the $6,000 deduction, which means your combined additional deduction is $12,000. If only one spouse is 65 or older, the couple gets one $6,000 deduction, not the full 12. This deduction is on top of whatever other deductions you're already taking. It's not a replacement, it's an addition. So if you're already claiming the standard deduction, which includes the existing extra amount for seniors, this new $6,000 gets added on top of that. Let me put that in real numbers so you can see how powerful this is. For 2026, let's say you're a single filer age 65 or older. Your regular standard deduction is roughly $16,550, which already includes the existing senior bonus. Now add the new $6,000 deduction on top of that, and your total deduction jumps to approximately $22,550. That means the first $22,550 of your income is completely shielded from federal income tax. You owe zero on that portion. For a married couple, both 65 or older, the numbers are even bigger. Your standard deduction plus the new $12,000 combined deduction could push your total deduction well above $42,000. That is a massive amount of income that the government simply cannot touch. And for many seniors living on Social Security and modest retirement savings, this could mean owing little to no federal income tax at all. Now, I know what some of you are thinking. Bob, this sounds too good. What's the catch? And you're right to be skeptical, because there are some very important eligibility rules you need to understand. The first and most important rule is the income limit. This deduction is not available to everyone over 65. It's targeted at seniors with moderate incomes. The deduction begins to phase out at a modified adjusted gross income of $75,000 for single filers. For married couples filing jointly, the phase-out begins at $150,000. Now, when I say phase out, I mean the deduction doesn't just vanish the moment you hit that number, it gradually reduces as your income goes above the threshold. So if you're a single filer making $78,000, you don't lose the entire $6,000. You lose a portion of it, and you still get to keep the rest. But if your income is significantly above those thresholds, the deduction phases out completely and you won't benefit from it at all. This is important because it means the deduction is specifically designed to help lower and middle-income seniors the most, the people who need it the most. Now let me explain what modified adjusted gross income actually means, because this is where a lot of people get confused. Your modified adjusted gross income, or MAGI, is basically your total income from all sources: Social Security benefits, retirement account withdrawals, pension payments, investment income, part-time work, added together with certain adjustments. It's the number on your tax return that the IRS uses to determine whether you qualify for various deductions and credits, and in this case, whether you get the new senior deduction. If you're not sure what your MAGI is, look at your most recent tax return. It's very close to your adjusted gross income on line 11, with a few possible additions depending on your situation. Now let's talk about who benefits the most from this deduction, because the answer might surprise you. The biggest winners are seniors whose income falls comfortably below the phase-out thresholds. Single filers under $75,000 and married couples under $150,000. For these people, the full $6,000 or $12,000 deduction applies, and the tax savings can be substantial. Let me give you a real example. Let's say you're a single retiree, age 68. Your total income is $50,000 a year from Social Security and IRA withdrawals combined. Without the new deduction, after taking your regular standard deduction of $16,550, your taxable income would be about $33,450. With the new $6,000 deduction added, your taxable income drops to roughly $27,450. At the 12% tax bracket, that $6,000 deduction saves you approximately $720 in federal taxes this year. $720. That's not life-changing for a billionaire, but for a senior on a fixed income, that's a month of groceries, 3 months of utility bills, or a meaningful cushion for unexpected expenses. And remember, this deduction is available for 4 tax years, 2025 through 2028, so that $720 a year becomes nearly $2,900 over the life of this provision. For a married couple both over 65 with a combined income under $150,000, the $12,000 deduction could save over $1,400 a year, or close to $5,700 over 4 years. Now here's something that a lot of people are going to overlook. You can use this deduction right now for tax year 2025. That means when you file your 2025 tax return in early 2026, this deduction should be available to you if you qualify. If you've already filed your 2025 return and you didn't know about this deduction, you may be able to file an amended return to claim it. Talk to your tax preparer or look into Form 1040X. Do not leave this money on the table. If you qualify, go get it. Now let's talk strategy. Because just knowing about the deduction isn't enough. You want to position yourself to get the maximum benefit every single year it's available. Strategy number 1. Manage your income to stay below the phase-out thresholds. If your income is close to $75,000 as a single filer, or $150,000 as a married couple, every dollar you can reduce from your MAGI keeps more of your $6,000 deduction intact. One way to do this is to pull money from your Roth IRA instead of your traditional IRA in years when you're near the threshold. Roth withdrawals don't count toward your MAGI. Another way is to time large retirement account withdrawals carefully. If you know you need a big lump sum, consider splitting it across 2 tax years instead of taking it all at once. Every dollar of income you shift below the phase-out line directly protects your deduction. It's simple math with a big payoff. Strategy number 2. Coordinate this deduction with your other senior tax benefits. Remember, this new $6,000 deduction stacks on top of the existing senior standard deduction that we talked about in a previous video. It also interacts with how your Social Security benefits are taxed, because if this deduction lowers your taxable income, it could indirectly reduce how much of your Social Security is subject to tax. In other words, this one deduction can create a ripple effect that saves you money in multiple places on your tax return. Not just one line, but several. Strategy number 3. If you're married and only one spouse is 65 or older, plan around the age requirement. Remember, you only get the full $12,000 deduction when both spouses are 65 or older. If one spouse turns 65 in 2027, then for tax years 2025 and 2026, you'd only get $6,000. But for 2027 and 2028, you'd get the full $12,000. Knowing this in advance allows you to plan your withdrawals and income around the years when your deduction is largest, which maximizes your overall savings. Strategy number 4. Don't forget about state taxes. This new deduction is a federal tax provision. It reduces your federal taxable income. However, whether your state recognizes this deduction depends entirely on your state's tax laws, and many states have not yet updated their rules to match. Some states automatically conform to federal tax changes, meaning you'd get the benefit on your state return too. Other states decouple from federal changes and may require you to add back the deduction on your state return. Check with your state's tax authority or your tax preparer to find out whether you get this benefit at both the federal and state level. It could be worth an extra few $100s. Now let me address some common questions I've been hearing about this deduction. Question 1. Does this deduction apply if I'm still working? Yes, there is no requirement that you be retired. The only age requirement is that you are 65 or older, and the income phase-out limits apply regardless of the source of your income. So if you're 67 and still working part-time, you can absolutely claim this deduction as long as your MAGI is below the phase-out threshold. Question 2. Can I claim this deduction if I itemize instead of taking the standard deduction? This is where it gets important. You need to check how the deduction is structured in the final law and IRS guidance, because some provisions like this are built into the standard deduction framework. If you're someone who itemizes and your itemized deductions already exceed the standard deduction, the benefit of this new provision may be smaller or structured differently for you. Consult a tax professional to be sure. For the vast majority of seniors who take the standard deduction, this new $6,000 amount will be straightforward and automatic. Question 3. What happens after 2028 when the deduction expires? Unless Congress passes a new law to extend it, the deduction goes away after the 2028 tax year. That's it. The window closes. Now, will they extend it? Honestly, nobody knows for certain. But historically, popular tax breaks for seniors tend to get renewed because cutting them is politically very difficult. But you should never plan your finances based on what Congress might do. Plan based on what the law says right now, and right now it says you have 4 years. Question 4. I'm 63 right now. Can I benefit from this at all? Not yet. You have to be 65 or older during the tax year to qualify, but if you turn 65 in 2027, you can claim it for tax years 2027 and 2028. That's still 2 years of savings waiting for you. Mark it on your calendar right now so you don't forget when the time comes. Let me quickly recap everything we covered. The One Big Beautiful Bill Act created a new tax deduction of up to $6,000 for individuals 65 and older, or $12,000 for qualifying married couples. It's available for tax years 2025 through 2028, 4 years, and then it's scheduled to expire. The phase-out begins at $75,000 MAGI for single filers and $150,000 for married filing jointly. It stacks on top of your existing standard deduction and can create ripple effects that reduce taxes on your Social Security benefits too. Use strategies like Roth withdrawals, income timing, and spousal age planning to maximize the deduction every year it's available. And check whether your state conforms to the federal change so you don't miss out on state-level savings. If you qualify and you don't claim this deduction, you are literally handing money back to the government that they told you to keep. Don't do that. Claim every dollar that belongs to you. If you found this helpful, hit subscribe, because every week I break down retirement money topics just like this in plain, simple English. No jargon, no fluff, just real information you can use. Share this video with anyone you know who's 65 or older. They might not know about this yet, and you could save them thousands of dollars. I'm Bob, this is Retired Not Broke, and I'll see you in the next one. And hey, leave a comment below and tell me if you knew about this deduction before watching this video. I'm genuinely curious how many people this is reaching for the first time.